If you bought silver this morning because you saw the headlines, I have bad news for you. You were the exit liquidity. Yesterday, the financial world was buzzing with one of the most bullish reports we have ever seen. Bank of America, one of the largest financial institutions on the planet, issued a research note predicting that silver could hit $309 an ounce. It was everywhere. It was on Twitter. It was on the news blogs. It was in your inbox. Retail investors looked at that number, $309, and they panicked. They thought, I have to get in now before it goes to the moon. So this morning, Wednesday, January 7th, they rushed in. They pushed the price of silver all the way up to $82.75. It looked like a breakout. It looked like the start of the run to triple digits. And then the trap snapped shut. At the exact moment the euphoria hit its peak, a massive wave of selling hit the market. The price didn't just stop, it collapsed. We are now trading at $78.54. We are down $2.62 on the day. That is a drop of more than 3%. If you bought the high at $82, you are already down 5% in a single afternoon. This is a textbook financial maneuver known as selling the news. The smart money used the bullish headline to dump their positions onto the dumb money who chased the hype. In this emergency market analysis, we are going to dissect exactly what happened today. We are going to explain why major banks issue bullish forecasts right at the top of a trading range. We are going to look at the double top that just formed on the chart, a dangerous technical signal that suggests we might have further to fall, and we are going to tell you how to survive this volatility without losing your position. The headline said $300. The chart says $78. You need to know which one to believe. This is the story of the Wednesday flush. To understand today's crash, you have to understand how a whale exits a trade. Imagine you are a hedge fund manager. You bought millions of ounces of silver at $60. Now the price is $80. You have a massive profit. You want to sell, but you have a problem. If you hit the sell button, your order is so big that it will crash the market before you can get out. You need buyers. You need millions of buyers to step up and take your bags. How do you find millions of buyers? You need a headline. You need a story so exciting that retail investors rush in without thinking. Enter the Bank of America report. Silver to $309. Whether by coincidence or design, this report provided the perfect liquidity event. When the retail herd read that headline, they flooded the market with buy orders. They created a wall of liquidity at $82. And the hedge fund said, thank you. They sold into that strength. They sold into the greed. They used the retail buying pressure to absorb their selling pressure. This is why the price crashed the moment the news went viral. The smart money was distributing their shares to the late money. It is a tale as old as markets. Buy the rumor, sell the news. The rumor was the breakout. The news was the target, and the result was the crash. Now, let's look at the technical damage. Charts have memory. Traders remember where they lost money before. Look at the chart from last week. On December 29th, during Ghost Week, silver spiked to $83.71 before crashing. That was the first rejection. Today, January 7th, we rallied to $82.75, and we were rejected again. We failed to break the old high. In technical analysis, this is called a double top. It looks like the letter M. It is a bearish reversal pattern. It tells us that there are aggressive sellers defending the $83 level. Every time we get close to it, they step in and smash the price. This creates a ceiling. Until we break $83.71 decisively, the breakout is on hold. We are stuck in a range. The top of the range is 83. The bottom of the range is, well, we are about to find out. We also have to look at the leader, gold. Gold is trading at $4,453. It is down $32 today. While silver is down 3%, gold is down nearly 1%. This tells us that the selling is broad-based. It isn't just a silver problem, it is a precious metals problem. Why is gold down? Likely because of the bond market. Yields ticked up slightly today. When yields go up, paper gold gets sold, and when gold gets sold, silver gets sold 3 times harder. That is the high beta curse. On the way up, silver is a rocket. On the way down, it is a rock. But notice something important. Gold is still holding the $4,400 level. It has not collapsed. It is just consolidating. This suggests that today's move in silver was an exaggeration. Silver overreacted to the downside, just like it overreacted to the upside this morning. It is an emotional teenager reacting to the steady parent that is gold. The parent is fine. The teenager is just having a mood swing. We need to discuss the psychology of a $300 price target. When a bank like Bank of America puts out a number like that, they are talking about a long-term forecast. They are talking about 2026 or 2027. But the retail investor reads the headline and thinks it means today. They think it's going to $300 by Friday. This mismatch in time horizons is what causes the losses. The bank analyst is looking at a supply deficit that will take years to play out. The day trader is looking at a 1-minute chart. The day trader buys the long-term forecast with short-term capital, and when the price drops $2, they get stopped out. You have to align your timeline with the thesis. If you believe silver is going to $300 because of a structural shortage, then what does a $2 drop on a Wednesday matter? It doesn't. It is noise. But if you are trading with 20 times leverage trying to catch a breakout, it destroys you. Today was a lesson in time frame management. The destination might be $300, but the road there is full of potholes. But let's not dismiss the report entirely. The fact that Bank of America, a bank historically known for being short precious metals, is now publishing bullish targets is a massive signal. It means the narrative is changing at the institutional level. In the next section, we are going to dive into the Bank of America report. We are going to look at why they raised their target. We are going to analyze their comments on solar demand and mining supply. And we are going to ask the question, is Bank of America trying to trap you? Or are they signaling that they have flipped their position from short to long? The pump might be fake, but the pivot is real. We are reading the fine print. If you are just joining us, we have analyzed the trap. We saw the price rip to $83 on a headline and then collapse to $78 on the reality. But we need to go back to the source of the explosion. We need to talk about the headline itself. Silver to $309. This wasn't a prediction from a YouTuber. It wasn't a post on Reddit. It came from Bank of America Global Research. In the precious metals community, Bank of America is known as the Death Star. For years, they held one of the largest derivative short positions in history. They were the hammer that kept the price down. They told their clients that silver was a waste of time. They told them it was just an industrial byproduct. But yesterday, the Death Star fired its laser in the opposite direction. They released a report that didn't just upgrade silver, it repriced the entire asset class. They said that in a bull case scenario, silver could top out at $309 an ounce in 2026. In part 2 of this investigation, we are going to tear apart that report. We are going to look at why the biggest bear on Wall Street just turned into the biggest bull. We are going to explain why this pivot is more important than today's price drop. And we are going to show you why this report acts as a permission slip for the $50 trillion of pension capital waiting on the sidelines. The price action was ugly, but the fundamental signal was beautiful. Let's look at the report. The report was written by Michael Widmer, the commodities strategist at Bank of America. He is not a fringe analyst. He speaks to the largest money managers in the world, and in this note, he admitted 3 things that the banking cartel has denied for decades. Admission 1, supply is inelastic. The report acknowledges that miners cannot simply turn on the tap. They admitted that even if prices rise, mine supply will remain flat or falling for years. This kills the bear case that higher prices will fix the shortage. They admitted the shortage is structural. Admission 2, solar demand is unstoppable. For years, banks said that solar panels would thrift silver away. They said engineers would replace it with copper. Bank of America just admitted that this is false. They project that the green transition will consume silver faster than we can dig it up. They validated the Samsung scenario we have been talking about for weeks. Admission 3, the monetary premium. They linked the price of silver not just to industry, but to gold. They said that as gold breaks out to $4,500, silver must follow to maintain the ratio. They admitted that silver is money. This is a total capitulation. It is the financial equivalent of a general surrendering his sword. The bank that fought the hardest against silver has just admitted that the math is undeniable. Why does this report matter if the price crashed today? Because pension funds do not trade off YouTube videos. They trade off research notes from major banks. Imagine you are a conservative fund manager managing the retirement savings of firefighters. You want to buy silver, but you're scared. You don't want to get fired if it crashes. You need cover. You need a piece of paper from a respectable bank that says it is okay to buy silver. Bank of America just handed them that paper. This report is a green light. It tells the institutional world the water is safe. The fundamentals are real. You're not crazy for buying this. This removes the reputational risk of owning commodities. So, while the day traders were selling the news today, the real money, the allocators, were reading the report. They were forwarding it to their investment committees. They were preparing the buy orders for next week. The report seeds the ground for the next wave of capital. It takes time for a ship to turn, but Bank of America just spun the wheel. We have to ask the cynical question, why would Bank of America publish this now? If they are short silver, wouldn't they want to talk the price down? Yes, unless they aren't short anymore. The only logical reason for a bank to publish a $300 price target is if they are net long. We believe that over the last month, during the Ghost Week volatility, Bank of America likely covered their massive short position. They used the liquidity to exit the trap. And now that they are out, they want the price to go up. They have switched teams. They went from being the suppressor to being the promoter. They want to create a mania because they are now positioned to profit from it. This explains the violence of the rally in early January. It wasn't just retail, it was the banks front-running their own research reports. This is how Wall Street works. First, they crash it to buy. Then they tell you it is going to the moon so they can sell it to you later. We are in the tell you it's going to the moon phase. And while it is cynical, it is incredibly bullish for the price. You want the banks on your side, and now they are. When a major bank puts a number like $309 into the public consciousness, it changes the Overton window. Before today, if you said $300 silver, people would call you insane. Now they say, well, Bank of America thinks it's possible. It normalizes the idea of hyper-bullish prices. It moves the goalposts. Suddenly, $80 doesn't look expensive. It looks cheap compared to $300. This psychological shift is critical for sustaining a bubble. You need the public to believe that the upside is infinite. This report creates a self-fulfilling prophecy. Traders buy because they think others will buy. Refiners hoard because they think they can sell higher later. Miners hold back supply because they want the Bank of America price. The target creates the behavior that makes the target come true. So, do not underestimate the power of this headline. The price dropped today because of mechanics, but the value of the narrative just went up tenfold. The idea of $300 silver has been planted in the mind of the market. And ideas are bulletproof, so the narrative is bullish. The banks have flipped, the institutions are coming. But we still have to deal with the ugly red candle on the chart. We have to deal with the fact that we are trading at $78. And technical analysis doesn't care about Bank of America reports. It cares about price action. In part 3, we are going to look at the technical damage. We are going to analyze the double top at $83. We are going to look at the support levels that must hold tomorrow to prevent a deeper correction. And we are going to answer the question, is the trend broken? We need to know if this is a bear trap or a trend reversal. The charts hold the answer. Stay tuned for part 3. We are drawing the lines. We have analyzed the psychology of the sell the news event. We have exposed the Bank of America flip-flop from short to long. But now we have to deal with the cold, hard reality of the chart. If you are a technical trader, looking at the silver chart today makes you nauseous. We just printed a massive red candle. We failed to hold the $80 level, and we have formed a structure that looks suspiciously like a double top. In part 3 of this emergency breakdown, we are going to put aside the conspiracy theories and look strictly at the price action. I am going to explain why the rejection at $83 is a serious technical warning sign. I am going to map out the kill zone between $75 and $78, the area where the bulls must step in to save the trend. And I am going to show you why, despite the ugly daily candle, the weekly structure suggests this is a bear trap, designed to steal your shares before the real move to $100 begins. The chart is broken in the short term, but it is building a monster in the long term. Let's look at the lines. Let's be honest about what the bears are seeing. On December 29th, we hit $83.71, and we crashed. Today, January 7th, we hit $82.75, and we crashed. This created 2 distinct peaks. In technical analysis, this is the classic M-top or double top pattern. It suggests that buyers are exhausted. It suggests that there is a massive supply of silver for sale above $82, and the market doesn't have enough money to chew through it. If this pattern plays out the way the textbooks say, the price should retreat all the way back to the neckline. Where is the neckline? $70. That is a long way down from here. That is why you are seeing panic on social media. The technicians are screaming, sell, because the pattern says we are going lower. But here's the catch. In a supercycle, driven by inflation and shortage, technical patterns often fail. A double top often turns into a high handle. Instead of crashing to $70, the price simply goes sideways. It flags. It digests the supply. And then, when the sellers run out of ammo, it rips through the double top like it wasn't even there. I believe we are forming a handle, not a top. Why? Because of the volume. Look at the volume on the sell-off today. Yes, it was high. But was it panic high? No, it was profit-taking high. It matched the volume on the way up. Now look at the bid support. Every time the price dipped to $78.40, it bounced. We are trading at $78.54 right now. We are not crashing through the floor. We are sitting on it. This tells us that there are passive buyers sitting at $78. These are the institutions we talked about. The pension funds. They didn't chase the price at $82. They waited. They let the traders flush the price down to them. And now they are quietly accumulating millions of ounces at the discount. When you see high volume but sticky price refusing to go lower, it means accumulation. The metal is changing hands. The weak hands are giving it to the strong hands, and strong hands do not sell. They hold for the next leg. So, where's the line in the sand? Where does the trend officially break? The fortress is built between $75 and $78. $78. This is the immediate support. It was the breakout level from earlier in the week. If we hold this, the bull market is incredibly strong. It means we didn't even need to retest the lower levels. $75. This is the major support. This was the ceiling for all of December. Remember the rule, old resistance becomes new support. If the price falls to $75, it should bounce hard. The entire market is watching that number. Banks, algos, and stackers all have buy orders sitting at $75. If we break below $75, then we have a problem. That would invalidate the breakout. It would be a failed move, but right now we are more than $3 above that danger zone. We have a massive buffer. So do not let a 3% drop scare you when you have a 20% cushion. Let's look at the RSI, Relative Strength Index. Yesterday, the RSI on the daily chart was pushing 80. That is overbought. It means the engine was running too hot. It needed to cool down. Today's crash accomplished that mission. The RSI has dropped back into the 60s. This is healthy. You cannot run a marathon at a sprint pace. You have to slow down, drink water, and catch your breath. The market is catching its breath. By resetting the RSI without destroying the price trend, the market has recharged its battery. It now has the energy to make another run at $83 next week. If we had kept going straight up today, we would have crashed harder tomorrow. So, in a weird way, today's drop saved the rally. It prevented a blow-off top and replaced it with a consolidation. Consolidations are boring, but they are sustainable. We need to check on gold again. Gold is down $32 to $4,453. This is a 0.7% drop. It is a flesh wound. It is nothing. Gold is still trading near all-time highs. It is still in a powerful uptrend. Silver dropped 3% because silver is volatile, but silver cannot enter a bear market if gold is in a bull market. Physics won't allow it. The gold to silver ratio widened slightly today. It went from 56 back to 57. This makes silver cheaper relative to gold than it was yesterday. This attracts the value buyers. The algorithms that trade the ratio will step in to buy silver and sell gold to close the spread. So gold is acting as the anchor. It is preventing silver from drifting out to sea. I want to warn you about the headlines you will see tomorrow. Silver crashes, the bubble bursts, investors flee commodities. The media loves a crash, it gets clicks. They will ignore the fact that silver is still up massive amounts for the month. They will focus on the one red day. Do not let the headlines dictate your emotions. The media does not know about the arbitrage. They don't know about the GSIB flush. They are reporting the price, not the mechanics. You understand the mechanics. You know that this was a sell the news event triggered by the Bank of America report. It was a tactical flush, not a strategic failure. So the chart is ugly, but the structure is safe. The support is holding. The indicators are resetting. What do you do now? Do you buy the dip? Do you sell the bounce? Do you hold through the pain? In part 4, the conclusion of this market alert, I'm going to give you the recovery strategy. I'm going to show you exactly how to trade the next 48 hours. We're going to look at the Friday close, why the weekly candle will determine the fate of the next month. And I'm going to leave you with the final verdict on the Bank of America target. Is $309 still real? Or was it just a dream? The trap has been sprung. The weak hands are gone. Now we see who is left standing. Stay tuned for part 4. The final plan is coming. We have reached the final chapter of this emergency broadcast. We have dissected the sell the news event that triggered the crash. We have exposed the institutional flip-flop from Bank of America. We have analyzed the technical damage of the double tops and the shooting star. Now you are left with a portfolio that is bleeding red. You're watching the price hover at $78.54. And you're asking the question that every investor asks in the middle of a correction. Is this the end? In this final breakdown, part 4, I'm going to give you the recovery strategy. I'm going to show you exactly what to watch for in the next 48 hours to confirm that the bull market is still alive. I'm going to explain why this Friday's weekly close is the only price that actually matters. And I am going to leave you with the final verdict on the $309 target. Is it a fantasy or is it a roadmap? The trap has been sprung. But if you're still holding, you haven't been caught. Let's finish this. In the world of professional trading, amateurs open the market and professionals close it. The daily noise, the spike to $83, the crash to $78 is just intraday warfare. The trend is determined by the weekly close. We have 2 days left in the week, Thursday and Friday. The battleground is simple. The bulls need to close the week above $75. If we close above $75, the weekly candle will show a long wick, but a green body. It will confirm that we are holding the breakout level. It tells the algorithms that the trend is up, but volatile. That is acceptable. But if the bears manage to push the price below $75 by Friday afternoon, it prints a failed breakout on the weekly chart. That would signal a deeper correction. So your eyes should be glued to that $75 line. It is the difference between a dip and a trend change. Given the physical shortage and the gold strength, the odds favor the bulls holding the line. Now, let's revisit the Bank of America target, $309. Today, looking at $78, that number feels like a joke. It feels impossible. But you have to separate timing from destination. Bank of America didn't say silver would be $300 on Wednesday. They said the fundamentals support $300 in this cycle. Did the fundamentals change today? Did the solar panels stop needing silver? No. Did the U.S. debt stop growing? No. Did the mines find more silver? No. The math that gets us to $300 is still valid. Inflation plus scarcity plus monetary reset equals triple digits. Today's price drop was a sentiment event. It was about emotions, not math. The math inevitably wins. But the math takes time. If you bought silver because you believed in the $300 thesis, a $2 drop should not scare you. It is a 0.6% pullback on the road to a 400% gain. Keep your eyes on the horizon, not the pothole. I want to give you the hardest advice in finance. Sometimes the best trade is no trade. When the market is whipping back and forth like this, when it is trapping longs and squeezing shorts, the best thing you can do is step away. If you try to trade around this volatility, if you try to sell at 78 hoping to buy at 76, you will likely get whipsawed. The market will reverse the moment you hit sell. It is programmed to maximize your regret. So the strategy for the rest of the week is passive observation. Let the banks fight it out. Let the algorithms churn the volume. You own the physical metal. You are outside the casino. You don't have to place a bet on every spin of the wheel. You already own the casino. Just wait for them to finish playing. However, if you are sitting on cash, if you missed the breakout at $70, this crash is your second chance. It is the market giving you a mulligan. We are back in the buy zone. Any price between $75 and $78 is a gift. You are buying a breakout asset that is retesting support. This is the lowest risk entry point you will get. Stop waiting for $60. $60 is gone. The new floor is higher. Recognize the opportunity in the crisis. While everyone else is panic selling, you should be panic buying the discount. So, here is the verdict on the trap. Bank of America issued a report to create liquidity. They used the retail excitement to offload some of their position or to reset their hedges. It was a cynical, ruthless move, but it does not change the truth. The truth is that silver is the most undervalued asset in human history. The truth is that the East is draining the West. The truth is that the price is heading higher, regardless of what happens on a random Wednesday in January. You have survived the shakeout. You are still standing. Do not let them steal your conviction. Do not let them steal your silver. The path to $300 is not a straight line. It is a war. And today we took some shrapnel. But we are still marching forward. Hold the line. Watch the $75 level. And remember why you started stacking in the first place. Subscribe.